it's not just soaring home prices and mortgage rates. So many factors are combining into an economic picture painful for many Americans.
Consumers are saying that they're pulling back on discretionary spending. They're also buying cheaper products, and they're paying less or they're buying less gas. And also in the face of rising interest rates, they're pulling back, or at least waiting, in terms of buying those big ticket items like homes and cars that require financing.
Bitcoin and other cryptocurrencies have taken a nosedive as interest rates rise and investors search for less risk.
In recent years, borrowing money has become increasingly popular. This is because people can use borrowed funds to make larger investments than they could otherwise. However, Raoul Pal warns that there's a trade-off to this strategy. If an investment goes wrong, the borrower may find themselves in a difficult financial situation. In today's video, I'm going to cover why Raoul Pal believes debt and leverage is a double-edged sword. We will also explore what's happening in the crypto market right now. But before diving into the video, be sure to subscribe to my channel for videos on economy and market happenings.
So leverage allows you to borrow future money to use now. So at two levels is humans are terrible. We just want everything now. We don't want to work for it. If I can borrow it and buy that Rolex watch or my new car, right? We're trying to meet our future expectations of ourselves always. That's what drives humans. So that's why they use leverage. And it's the same with investments. So they do it for purchasing power, to bring that future expectations of themselves. Have I earned enough money to buy that car? No, but if I borrow money, I can get my future self here. It's kind of a trade-off because you're actually in debt and now owe somebody. You don't actually own the car. You own the ability to use the car until you pay that off. It's the same with a house, really. And the other point is for investments. You know, people love to borrow money now because then you can make a bigger investment now. But the trade-off is what happens if that goes wrong? Then before you know, you get a margin call or liquidated. And you know, that's a feature we see a lot in the crypto markets, for example. It happens kind of automatically. So humans just love this stuff because it brings their future expectations of themselves closer. I could be richer. I could have more stuff than I deserve now from my income. You can get in trouble if you can't pay your interest. So let's say the economy slows down and you lose your job. Now, what seemed like a reasonable payment suddenly becomes impossible. And then you get in arrears, and then you get the little tap on your shoulder, which is like, I'd like that house back now. Because you don't own that house. We, the bank, do. This is what people don't understand with leverage. You don't own that thing. You only own it when you pay it off. So that's what happens when you lose your job. You then can't afford to pay your mortgage payments. Now, there's a difference between the US and Europe for this. So the US, you give the keys back to the bank. It's not the end of the world. In Europe, the debt stays with you.
Oh, God.
Yeah, it's very different. So it is a
They get the house back and you still owe the debt?
Correct, because the house is valued less, particularly when what we refer to as negative equity. You buy a house for 300 grand and it's now worth 200 grand. You owe the bank 100 grand. Now, it's okay if you can still make the payments and eventually you just pay off the mortgage. But the moment you can't, they're like, well, you owe us 100 grand. And they take you to court and you carry that and you go to bankruptcy.
Oof.
And that's how housing is rare in the US. Most other leverage doesn't have the same process. Most of the leverage get the tap on the shoulder saying, I want my money back. And you end up going to court and you end up going bankrupt.
According to Raoul Pal, we use leverage in life because we're always trying to make our future expectations of ourselves, which we believe is better than our current reality. There's no denying that people like to borrow money now because you can make a bigger investment. But the trade-off is, what if I go wrong? That's a valid concern, and one that you should consider before taking out a loan, because you don't own that, the bank does. And at times, like what's happening right now, when the economy goes down, interest rates go up. And if you find yourself in the position of being unemployed, it can be a difficult time financially. He explains that what seems like a reasonable payment suddenly becomes impossible. Do you agree with him? Also, if you find this video informative, be sure to give a thumbs up. Now, you must be thinking, what about the crypto market? Because you're not making any payments there, so it must be safe there. Right! Let's hear what Raoul Pal has to say on this.
So leverage works in crypto that you have some Bitcoin and you want to borrow some more Bitcoin or some US dollars or whatever it is you want to do. So you will pledge your Bitcoin and your interest payments
As collateral.
And your interest payments are whatever they are. But what happens is if the collateral falls and the exchange or whoever it is, or the DeFi protocol says, oh, it doesn't cover the amount, you get liquidated immediately. There's no negotiation, no, oh, please, no, nothing, just like boom, out, and you take the loss. So when you go into the financial markets, like the futures markets, which is mainly for accredited or sophisticated investors, it's not an instant liquidation. And that's terrifying. Because suddenly, something like the oil price, let's say you've bought some oil futures, what that is leverage on the future price of oil. That's like you would do with Bitcoin. But oil sometimes can go down 10% a day. And because you've got leverage, before you know it, you're losing enormous sums of money. They don't liquidate you. They call you up and tell you owe them margin. And you can get yourself in a huge mess. So leverage is very scary.
Leverage in the crypto market is a scary thing. That's the opinion of Raoul Pal. Leverage is like a double-edged sword. It can help you make big gains in a short amount of time, but it can also lead to big losses, especially when the market is so highly volatile due to the bad economy. It's really been a tough month for crypto investors. Over the past month, a large amount of capital has been wiped out of the crypto sector. Bitcoin underwent a massive deleveraging event lately, both in on-chain DeFi markets and off-chain. This event caused a domino effect that led to the insolvency, illiquidity, or liquidation of hedge funds, other financial institutions, and lenders. This has led to many investors feeling anxious and worried about the future of the industry. As of June 26, Bitcoin's futures estimated leverage ratio across all exchanges sits at 0.226, according to Glassnode. The Ethereum DeFi market is also in the midst of a dramatic deleveraging, with over $124 billion in capital flushed out in just 6 weeks. This represents a significant shift in the market, and it is likely that this trend will continue in the coming weeks.
As prices go up, the economy slows down for the exact mechanism, and therefore it becomes self-regulating. And it becomes that because people are quite in debt, and it's a very old population in the US and Europe and elsewhere. So if you raise prices on your retired parents, they can't earn more money because they've got their pension, and that's it. So what happens is they end up buying less, and there's a big cohort of people. So that's why I think it automatically over time kind of self-corrects. But the other mechanism is the bond market, which is a fancy name for saying interest rates, the price that you and I and companies and governments can borrow. So if it becomes more expensive to borrow, so think of your mortgage, if you've got a mortgage, well then if it becomes more expensive to borrow, then you spend less. Right, so the interest rate market forces demand to come lower. Now, let's say you don't have a mortgage and you're a renter. Well, the person you rent from has a mortgage, so they will raise your rent because of it, which is why everybody's feeling this pain now, feeling a bit poorer.
Everyone is in debt. It's a debtful market. People like to buy things with borrowed money. Raoul Pal explains how the market gets affected with increased interest rates. So you see, as the prices of borrowing become expensive, your purchasing power decreases. In simpler terms, the interest rate market forces the demand to come lower. We can conclude that leverage is a powerful tool that can help us achieve our goals, but it can also be very, very dangerous. And many people have found themselves in debt or worse because of it. This all-over downward trend in the crypto market is likely to have a number of implications, and it will be interesting to see how the market evolves in the coming weeks and months. Have we reached the maximum pain, or is it just the beginning of something more painful? Let me know your thoughts in the comments below. Be sure to subscribe to my channel for more videos like this. I'll see you all in my next video. Adios!